But what does all of this mean for the oil and gas stocks? Well, your next guest is bullish on parts of the oil business. And today, he's calling 10 different exploration and production companies as outperforms. Joining us now to talk about it, Neal Dingmann. He is energy analyst at Wiliam Blair. Neal, great to have you on the program. I love your names because these are not the Chevrons and Exxons of the world. These are the Diamondbacks. These are the Vipers. These are the Permian Resources, kind of the more mid-cap size names. Diamondback is a name that every time I talk to everybody, they say, look at Diamondback and what that team is doing. Why do you like them?
I mean, that's simple. By the way, nice to have you. Good to see you, Sully. Diamondback is easy. It's the lowest, the company with the lowest well break even. Company makes money down to even $40, $35. And, you know, even at 65, where we're at today, 63 to 65, they're just printing dollars. So you look right now, and, you know, not to mention, you mentioned Viper. They have that subsidiary public company, Viper. It's the largest mineral company out there by a large extent. Having that combination, I just think, gives them a huge, huge advantage.
Yeah, and you referenced oil and gas prices. And by the way, if you figure out where prices are going, let me know, because every expert I talk to has got a different view, and they'll probably both eventually be right. But the president did say, he kind of promised the voter he wanted lower oil and gas prices. The question is, how low might it go? If it goes down, maybe it goes higher. But you feel like there is kind of a floor at $60, Neal?
I do. We're a bit non-consensus here. We're calling for a bit of a oil bottom. I guess you'd almost call it an inflection point, and that's driven by a couple things. I think, one, our data shows that U.S. production. Remember, I think investors forget that oil is right now. U.S. production is around 13.5 million barrels a day, but the U.S. companies have to produce 5 million just to keep that flat. It's the only industry where you have that type of declining asset out there, if you will. So one, I think the supply side, especially domestically, is going to be more challenging. And then even the demand side, I think, again, EIA, IEA, others estimate, I know they're calling for $50-ish oil next year. I mean, shoot, they're wrong probably 30% of the time. So I'll take the bet the other way of what they're saying.
Yeah. And by the way, OPEC is a little more bullish on oil as well. So kind of a split between the IEA, the acronym agencies, and then, of course, OPEC. Back to the names here. Crescent Energy, Magnolia Oil, Mach Natural Resources. These are not widely known names. I mean, I've heard of them. I couldn't tell you a whole lot about them. What makes these smaller caps outperforms to you?
That again, kind of like a Diamondback, they can operate in a low environment. You look at somebody like Magnolia, you mentioned. This little company has over 500,000 acres, all in the Eagle Ford. They virtually have no debt, so they can take on. And, again, if there is pressure on prices, a lot of these companies, I'll use Magnolia as an example, they can come in, buy assets on the cheap, and add that to their existing production. So, again, some people view a temporary lower prices as just a negative. Look, a better company like a Magnolia is going to come in, use that to their advantage, and take that external production, add it to their organic, and make the company even better off for it. And look, Sal, I think you know this better than I. I mean, the amount of shareholder return my group is paying out, I think, is second to none. I would put that up against any other sector analyst and try to show another sector that's paying out more shareholder return, whether that's buybacks, whether that's base dividends, whether that's variable dividends, you name it.
But here's the weird sort of dichotomy, Neal, is that the push for free cash flow return, shareholder return, is now. It's not 5 years from now. It is right now, which means these companies, the ones you cover and many more, they want to kick a lot of that cash back to shareholders or make decisions that benefit the stock. That may not always mean drilling for more oil. And there are some very smart people I've talked to that say they think U.S. oil production is going to go down, not up, because companies, while they may listen to the president and respect what he says, they're going to do what's best for shareholders, not just because the White House tells them to do something.
That's right. I think the drill, baby, drill, that's not going to happen. I think it's, just the opposite of that. And I think what's key, though, for the better companies is, fortunately right now, Sully, their reinvestment rate for most of them is only about 45%, the ones that are not as good. can have a reinvestment rate as high as 75%, meaning they have to reinvest at least 75% of their capital to keep production flat. So again, the Diamondbacks, the Magnolias, the Permian Resources, some of these that you mentioned, fortunately, they have such a low reinvestment rate that I think, one, they can keep production flattish. None of them want to grow it at these prices. It doesn't make sense. But they can keep paying out these kind of returns to shareholders. So again, if a shareholder wants to get a big dividend, if they want to see their per share growth go up, I just don't think there's a better sector to find.